Hi there, Happy New Year and welcome to this episode where we'll focus on the fixed income and macroeconomic review for 2023 and our outlook for 2024. I'm your analyst, Stella Swakei. 2023 was a year of several highlights. For one, we experienced relatively good weather which boosted the agricultural sector and consequently the overall growth of the economy. The estimated growth for 2023 is 5%, and for sure the agricultural sector will take the center stage as it recovers from the previous year's contraction. Over the same period, inflation averaged 7.7%, which was slightly higher than CBK's target ceiling of 7.5%. All the same, the cost of living remained high as the apparent softening was largely attributed to the higher base in the comparison period. Nonetheless, food prices significantly contributed to the eased inflation in the second half of 2023. On the private sector business environment, conditions remained in the contraction zone for the better part of 2023 due to higher input prices, which consequently led to higher output prices as businesses endeavored to maintain margins. The key drawback was the elevated fuel prices as well as the weakening currency, which substantially led to the rise in the input prices. Notably, the shilling was on a roller coaster, shedding 26.8% against the dollar in what seemed closer to the depreciation witnessed in 2008 following the post-election violence. To counter currency-related inflation, the CBK raised the central bank rate by 200 basis points towards the end of the year, resulting to a total of 375 bips hike throughout 2023. On the fixed income front, the yield curve saw an inversion in 2023 as yields on short-term papers increased at a faster rate as compared to yields on the longer-term papers. The phenomenon led to unrealized losses on previously acquired bonds, which investors had held for sale. It also implied declining confidence in the country's long-term outlook as perceived risks on debt sustainability persisted. Both treasury bills and treasury bonds were oversubscribed, with the government raising 1.3 trillion from the short-term papers and 713 billion from the longer-term papers. The second half poses several positives, including possibility of rate cuts, which will consequently support the private sector business environment and the overall economic growth. We also expect a slowdown in investor flight, which will support dollar inflows as well as FDIs. Maybe 2023 was a tough year, or maybe the downsides that we experienced were not as hazardous as we thought. Maybe it was a demanding process that we had to endure in order to see happier days. Like tides ebb and flow, bad seasons come and go. To see the full report, please see the link below. Also, watch out for our outlook on the same as well as the equities market. Thank you and bye.